Yatsana says, Hi, Austin and Robert. I'm an avid listener of the Rich Habits podcast and frequently recommend it to others, especially younger folks, as a resource for building a strong financial future. My husband and I, who are both 51 years old, have followed sound financial habits, which means we max out our 401ks, including those catch-up contributions. We make a backdoor Roth IRA contribution every year, and we were able to even cover our two sons' college expenses. We now have an extra $450,000 to invest and would love your advice on how to allocate it. We're drawn to funds like VOO, VGT, SPYI, and QQQI, but we'd appreciate your insights, specifically on asset allocation, bonds, equities, alternatives, things like that, fund selection, are there other ETFs we might be missing, and then even some weightings. Do we go all in on stocks? Do we have some diversification? Would love your all's thoughts, and thank you so much for the invaluable knowledge that you share. It's made a real difference in our financial journey. Robert, you want to kick this one off?
I would love to. Let's see how close we are in agreement for this scenario. So it's a great question. I would say, as far as asset allocation, a lot of people think in times when there's market volatility, they should really go all in on bonds. I don't agree with that. I don't think your bond should be more than 5% or 10% of your total money invested. Next, I would say equities could be anywhere from 40 to 60%. And then with cryptocurrency, I would say 5 to 10% of your net investable capital. And then when it comes to alternatives, you mentioned alternatives, that can range anything from crypto to real estate to precious metals. Again, for me, that's a 10 to 15% allocation amount. So that's how I would break it down first and foremost. When it comes to fund selection, you've already named a lot of the ones that Austin and I like. And fund selection to me is really an important part of this answer because I feel too many people try to get too fancy. I see people all the time with their portfolios where they've got 15, 20 or more funds, and I just don't think it's necessary. There's enough overlap in most of the funds we talk about to cover all of the sectors we like. And so in that instance, I think the average person that's building their wealth should have 5 to 10 funds total. And we really like people starting out with the VOOs, the VUGs, the QQQ. And then if you want the dividend income, we love SPYI and QQQI from Neos funds. And then if you want to explore AI, we like AIQ. I think that's a really good long-term fund that'll make people money in the emerging sector of AIQ as it gets bigger and bigger. So that's the take for me of what I would do in your situation, because you want to be diversified, but you want to make sure that you're catching all of the secular growth trends so you can make the most money in those sectors while still maintaining quality products like VOO where you're betting on the US economy. That's what I would do.
So as it relates to like this $450,000, the first thing I want to encourage you to do is to dollar cost average the money, right? Don't put all 450,000 into whatever funds that you decide with whatever weightings all at once. My general rule of thumb is if the amount of money that I'm investing is more than 10 to 20% of my total portfolio value, I'm going to dollar cost average it. So for example, let's say you've got $1 million portfolio and you've got $20,000. 20 grand is only 2% of $1 million portfolio. The markets move up and down 1 or 2% on a daily basis. Just go chuck it into your portfolio. You'll be just fine. Don't worry about dollar cost averaging that over a period of time. But if we're now talking about $500,000, well, that's 50% of your portfolio, right? That's a big number. So if this 450,000 makes up more than 10 or 20% of your total net worth, your total invested portfolio, dollar cost average it maybe over like 3, 4, 5 months, right? Nothing too crazy. Don't wait too long, but don't do it all at once either. As it relates to asset allocation, I love the idea of putting the vast majority of this into equities, specifically ETFs, right? You mentioned VOO, VGT, SPYI, QQQI. I'll add VUG, VTI, AIQ, I think all those were wonderful. Moat is another great one, MOAT. I think that's great. Say maybe 400,000 in the equities and then maybe 50,000 in cryptocurrency. If you want to put 50,000 of that into IBIT, IBIT or BTCI. Those are both Bitcoin focused ETFs. Or maybe you want to just go buy Bitcoin directly via some sort of exchange like Coinbase. I think that's great too. Just make sure that you don't have more than 5 to 15% of your total invested capital in cryptocurrency. And then as it relates to like breaking all this down from a weightings perspective, Robert and I firmly believe in the core satellite portfolio strategy, which essentially means 65 to 80% of your portfolio should be invested into the index funds and ETFs we talk about, whereas the other 20 to 30% of your portfolio should be invested into those diversified, asset classes. If it is precious metals, if it's crypto, if it's real estate, if it's single stocks, whatever that might look like for you, but having the vast majority into index funds and ETFs and having some nice, diversification on the other side of it, I think that's a well-rounded portfolio.
Yeah, I agree with everything you'd said. And the only thing I would add on top of what we've already answered is you're both 51 years old. So you have a long investing horizon ahead of you. So just keep in mind, you don't want to become too risk off too early, because then you're going to leave a lot of money that you might desire to have in retirement on the table because you pulled your foot off the gas too soon. I see this happen all the time. At 51 years old, you have a solid 12, 13, 14, 15 years, 20 years before you're really fully into retirement. So you want to make sure you get as much money out of the money you have now by investing wisely, not going all in on some crazy sector or some crazy stock, but also giving yourself the chance to make the best returns possible over that next 10, 12, 15 years.